Good afternoon. Thanks for joining us today. We're going to go ahead and get started in just a few moments.
All right, I'd like to say good afternoon and welcome to everyone who has logged in to join us today. Maybe we'll have a few more folks dial in here in a minute, but we can go ahead and get started. Like I said, I'm glad you all took the time and we appreciate you dialing in to listen to us today. My name is Ed Wood. I'm a partner here at Cornerstone Wealth. I work in the Charlotte, North Carolina office, as well as the Columbia, South Carolina office. I am joined today by my colleague, Jeff Powell, who works in our Greensboro, North Carolina location, as well as our Aiken, South Carolina location.
Hello, everyone.
To get started, I just kind of like to reiterate what we do at Cornerstone. And, you know, the two big things that stick out in my mind are that we specialize in asset management and financial planning. And many of you might have joined us over the past few months for some of our other webinars, such as tax planning, emotional considerations in retirement planning, and many market updates by Cliff Hodge, our Chief Investment Officer. Those are just a few of the webinars we've done, and we're going to continue to do these. So today I'm going to continue down this path of planning, and we're going to discuss the Roth IRA conversion. Now, the Roth IRA conversion involves converting a traditional IRA or rollover IRA or after-tax 401k contribution to a Roth IRA. And before we get too far into the presentation, I thought it might be important to review some of the similarities and differences between the traditional IRA and the Roth IRA. They both have been around for quite some time. The traditional IRA was established by the Income Security Act of 1974, and the Roth IRA was established by the Taxpayers Relief Act of 1997, named after Senator William Roth. Now, taking a look at the traditional IRA, I've got some bullet points here just of some things that are important about it. The main one typically in both of these is the tax benefit. They grow tax deferred. They have taxable distributions at age 59 and a half or older, but still what a great tax benefit. You get to put money in something typically on a pre-tax basis, but sometimes on an after-tax basis, and it grows tax deferred, and you take it out and you pay tax later in hopes of being in a lower tax bracket. There are contribution limits for 2020, $6,000 per individual taxpayer and $7,000 if you're age 50 or older. There are no earned income limits. There is no age limit, but you must have earned income. And they are subject to required minimum distributions. So in our planning with our clients, we encounter this most often probably, and that's the fact that once someone reaches age 72 now, thanks to the Secure Act of 2020, you are required to take minimum distributions from your IRA. And there's a formula there. It involves life expectancy and the prior year 12/31 account value of the account. And the goal is so that the government can collect its tax revenue on those accounts slowly by your age 97 is how that would work. There are some opportunities for deductions here in a traditional IRA, so it can be deductible, but they are subject to some deduction limits, which you can see here on this slide. I won't read through all of them, but the two that we see most often are the married filing jointly and covered by a plan or retirement plan at work. So if your income is $104,000 or less, you can take the full deduction of your contribution amount. If your income is $124,000 or more, you cannot take the deduction. And for a single filer, $65,000 or less is the amount. You can take the full deduction. If you make more than $75,000 or more, you cannot take a deduction. There's some opportunity in there for partial deductions, some phase outs and so forth in here. So, those are opportunities for you to take a deduction on a contribution to a traditional IRA. When it comes to the Roth IRA, as I mentioned, there are some similarities, and they both have great tax benefits. Tax-free growth with the Roth IRA versus tax-deferred growth in the traditional IRA. The money grows tax-free, and as long as you keep it in there for at least 5 years or age 59 and a half, whichever's longer, then you can access that growth in that account on a tax-free basis. You do have access to your principal, the contributions you've made, the after-tax money you've put in. Those funds you have access to at any time, penalty-free or tax-free. The contributions to the Roth are not deductible. So again, it's funded with after-tax dollars, but you'd be willing to give that up in order to get tax-free growth and tax-free distributions. There are contribution limits, just like the traditional IRA, $7,000 if you're age 50 or older, or $6,000 if you're under age 50. There's no age limit for participating in a Roth IRA. And the biggie here is that they're not subject to required minimum distributions during the account holder's life. So here's one of the big differences, unlike the traditional IRA, you are going to be subject to required minimum distributions Here in the Roth, you do not have to do that. And we're going to talk a little bit later. Jeff's going to give us an example of why this is so important with the Roth conversion. There are earned income limits on contributions, but not on conversions. Another important caveat here, the earned income limits preclude a lot of people from participating in a Roth IRA. Here, married filing jointly, if you have a modified adjusted gross income of less than $196,000, you can participate in a Roth IRA. If you make more than $206,000, you cannot. Single, less than $124,000, you can. More than $139,000, you can't. So, you can see here that many of our clients, they cannot participate in the Roth IRA. But both of these IRAs are great tools from a tax planning standpoint, tax diversification standpoint. You're going to hear that again later, tax diversification. So, you want to make sure that if you cannot participate in a Roth IRA, you are looking for opportunities to participate in a Roth strategy through conversion. Jeff, why don't you take a few minutes and talk about why people might want to convert or not convert existing IRAs into Roth IRAs?
Sure, thanks, Ed. So why would I want to convert money from a traditional Roth or traditional IRA to a Roth? And it really comes down to taxes and your view of taxes. So you can pay your taxes now, you can pay them later on. And if you're currently in a lower tax bracket and you think in the future you're going to be in a higher tax bracket, then it makes sense to convert, makes sense to move money over. If you have financial loss,
looks like Jeff might be having some
taxes that you have to pay to move or convert assets over, then it makes sense. If you do not want to, let's say you're fearful that your RMD is going to be extensive, then you may want to look at converting to decrease that amount and utilize your Roth. We're going to talk more about that later. Let's say in retirement, you're thinking of moving to a state that has a higher income tax rate. Again, you want to make sure you try to convert now while you can. And the last part, we talked a lot about taxes and paying more in taxes, but it's also a way to give tax-free inheritance to your heirs by moving them to a Roth IRA. So these are some reasons why you would convert. So then why wouldn't you convert? Well, if you think you're going to have a much lower income tax bracket in retirement, then it doesn't make sense to convert. You're paying much more in taxes. Extra money for the conversion. You have to be able to pay these taxes when they occur. So in the same year that you move money over, you have to pay taxes. And so you have to have the money available to do that. And then the other thing that people don't think about is you have to wait at least 5 years or you're penalized for taking that money out. And so if there's a chance you're going to need funds earlier, then you may want to wait and convert later. So we're going to talk about 4 potential planning strategies involving the Roth IRA conversion. And the first is your basic Roth conversion. The second is an unwanted RMD, which we've talked about a little bit. And the last 2 are a little more complex, and we're going to get into them a little more in detail, which is your backdoor Roth IRA and your Mega Roth conversion. So the first one's the basic Roth conversion, and that's really exists of a rollover IRA or a traditional IRA being rolled into a Roth. And it exists, the conversion, you're basically taking an IRA balance and you're rolling it to a Roth to decrease your tax bracket upon retirement. And what I mean by that is converting over and utilizing a Roth can help you down the road with your taxes. So the next thing is the unwanted RMD. And the unwanted RMD, a lot of people with sizable IRAs, traditional IRAs, upon age 72 are going to be required to start taking money out. And that can be an extensive amount of money, which also means an extensive amount of taxes. And so one way to defray that is by slowly converting money over to a Roth and therefore decreasing your required minimum distribution once it occurs. A nice thing right now is under the CARES Act, if you've already taken your RMD for the year, you're already retired, you're required to take an RMD. If you've taken it, you can then take that amount and move it to a Roth IRA. And because you're already paying taxes on the traditional IRA money, you might as well move it to a Roth and then get tax-free growth for the remainder of that account's life. If you've received a distribution from your traditional IRA, you can contribute it, roll it over to a Roth within 60 days, covering your distribution back to January 1 of 2020 for your tax year. So the next one we're going to talk about in more detail, and that's the backdoor Roth IRA. And why does this concept exist? Well, it exists for people that are making more money and are phased out of putting money into a Roth IRA, which I talked about earlier. Your adjusted gross income, if you're single, is above $139,000. Married, it's above $206,000. But let's say you still want to put money into a Roth IRA for the future. You can accomplish that by opening a traditional non-deductible IRA, and then after a few days, converting that money over to a Roth IRA. And I say a few days because you don't want to leave assets in the traditional IRA, because then any growth that happens on those assets is taxed as income when you take it out and you move it to a Roth, where being in a Roth, you're going to get that growth is not going to be taxed. So it's a simple process to complete if you have no other IRAs and you're owned by a taxpayer. Taxes will be due on any growth experienced in the traditional IRA prior to conversion, and that's important to remember in moving that. So a backdoor Roth, it involves complex tax calculations, especially if you have assets that you've put into a traditional IRA that have already been taxed. And so here's the following steps for the backdoor calculation. You have to consider all traditional IRAs owned by the taxpayer. And what that means is you may have one IRA that you're planning on moving some money to a Roth, but then you have another IRA somewhere else. You have to include all of them in this calculation. So this calculation is called the Pro-Rata Calculation. And another thing to remember is it doesn't happen until the end of the year. So all values for these accounts are at year's end when you're doing this calculation. That's why, when we're talking about these, it's so important that you talk to a tax professional and your financial advisor, because running through this calculation, you have to make sure that it's done correctly the first time, because they've removed what they call Re-Characterization, which is allowing you to move money from a Roth back to an IRA, a traditional IRA, if your calculations were off. That's gone now. And so you have to make sure these are done correctly the first time. And so all the growth up until the end of the year, even the positions that are left in the IRA are considered in this calculation. Another thing to remember, another pitfall with doing this is, let's say you're retiring, you start moving money to a Roth IRA and you're going to pay taxes, but in the same year, you roll your 401k into an IRA. If it's done in the same year that you move money to that Roth, it's also included in the calculation, and it counts as an IRA, even though originally it was a 401k. So it could increase your tax obligations. And the second thing to note is simple and SEP IRAs are also included in this formula. One good thing is inherited IRAs are not included in the formula. And I'm going to walk through an example now. So the formula for a pro-rata calculation is the total after-tax money in all covered IRAs divided by the total value of all covered IRAs at year end multiplied by the conversion amount. And so here's an example to kind of go through that, because this is where it can get, complicated if you have after-tax dollars in a traditional IRA. Because you would think, that after-tax dollars you could just move over into a Roth IRA and not pay taxes on them, but that's not true. And that's why this calculation is so important. So let's say a taxpayer had added $30,000 of after-tax dollars to a traditional IRA in the past 5 years. The current value of the IRA is $100,000, and the taxpayer has another IRA with $50,000 in it. She wants to convert $30,000 after-tax contribution from her IRA to a Roth. So the calculation looks like this. You take the $30,000 and you divide it by the total, which is the $100,000 IRA and the second $50,000 IRA. So you take those, you divide them, it comes out to 20%. You take the $30,000 of after-tax contributions, you multiply it by the 20%, that gives you $6,000 of after-tax money leaving and $24,000 pre-tax amount. So you're paying taxes on that $24,000. So that's why it's so important to have this calculation and consult with your tax and your financial professional.
Thank you, Jeff. I'm going to spend a minute now on the Mega Roth strategy. And this is a little more complicated probably than the other three, but it's important to note that it is available to you sometimes through your 401k. So one of the first things that we talk to clients about when we're doing planning with them is we tell them, max out your retirement plan at work, max out your 401k. Well, this particular strategy is going to give you the ability to convert amounts in a retirement plan that would otherwise be tax deferred to amounts that would essentially be tax-free for little or no additional cost from the conversion. So there's something called a Section 415 limit, and that's an internal revenue code limit that tells us how much money we can put into 401k from an employee standpoint and from an employer standpoint. So it says that 2020 employees can contribute $19,500 with a $6,500 catch-up provision for age 50 or older. Those limits also give us the total contributions for employee and employer through profit sharing and company match of $57,000 in 2020. So you can have a total amount going into your 401k plan of $57,000 in the year 2020. So if you are an employee earning $150,000 and you've put your $19,500 of employee deferral into the 401k plan, and the employer matches 4% of salary, that's going to be $6,000, which would give us a total of $25,500 into the plan. There's still room there of $37,500 before we reach the 415 limits. The plan, if it allows, the plan will give you the ability then to make an after-tax contribution of up to $37,500 and then convert it to a Roth IRA while you're still working, which is also important to note. You don't have to leave or have separation of service to participate in this Mega Roth strategy. But two important things have to be in effect. The plan has to have this in the document. It has to say that it allows for after-tax non-Roth contributions, and it also has to allow for in-plan Roth rollover or in-service withdrawals. Those two things would allow movement of the after-tax contributions to the Roth IRA. One other thing to be aware of, there is some testing that the administrator of the 401k has to do each year. One of those tests is called the Actual Contribution Percentage Test, or ACP. If you're considered highly compensated, making $125,000 a year or more, those tests sometimes hurt you in the way of your contribution amount. You can only contribute 2% more than the average deferral of the non-highly compensated employees. So that is also going to affect you on the Mega Roth strategy with the after-tax contribution as well as the pre-tax contribution. However, on the pre-tax contribution side, the administrator can implement something called a safe harbor, which will allow you to bypass that part of the test, and it will allow you to fully fund the 401k. But on the actual after-tax contributions, the safe harbor will not help in that situation. So you'll want to check if you're able to participate, that's great, but you'll also want to check, hey, are we going to be able to pass this ACP test, or am I going to end up getting money back at the end of the year? So the caveats with the Mega Roth, in addition to the plan rules allowing for the conversion and the distribution, there could be income tax that's triggered here. Just like doing a normal basic Roth conversion, any of the conversions, you will owe tax on the amount converted in the year of conversion. So as Jeff mentioned earlier, when you make your contribution, you're not going to want to wait too long before you do the conversion, because any time period in there that experiences growth in the account will create a tax liability on that conversion. The other caveat, you must wait 5 years or have attained age 59 and a half, whichever's longer, or be disabled before you can access the growth in the Roth conversion penalty-free or income tax-free. So that's, again, no different than the other conversion options or the typical Roth IRA. So if you are participating in the Mega Roth strategy, you might be able to do this totally internally in the plan without taking money out. Again, it's a design feature, but you'd be able to convert the after-tax contribution to Roth 401k balance within the plan without taking a distribution from the plan. But your plan has to have the Roth 401k. It has to have the ability for you to make after-tax contributions and the ability for you to do an in-plan Roth rollover. The other way is that you could convert the after-tax portion of the contribution to a Roth IRA outside of the plan. Now, this is the one we've seen most often, even though this strategy isn't used that often. But the plan must allow for in-service distributions to do this. I looked up some statistics here, and about 48% of the 401k plans out there have this particular strategy as something that the participant can do, but only 6% of the participants in those 48% of the plans actually take advantage of it. So it's something that maybe an advisor's not talking to you about. Certainly, a lot of times the plan administrator doesn't share that information or the strategy as well either. So if I'm looking at where this strategy might be most effective, you see here non-highly compensated employees. That's because they don't have to worry about the non-discrimination testing. That ACP test won't matter for them. So people making under 125,000 that's not considered highly compensated, if they want to participate and the plan allows it, it would be a good option for them to get more money in the Roth over and above, say, the $6,000 or $7,000 annual limit. For highly compensated employees, however, maybe not such a great idea unless you are at a company that has a lot of participants in the 401k, and it will not make a meaningful change in the ACP testing at year end. So that could be an option. Again, it's something you'd have to see if you're eligible to just test the waters a little bit to see if you'd pass that ACP test. It's something the plan administrator should be able to give you information on. The third option here is for solo 401k participants. The solo 401k has been a popular plan design for a number of years now. And as the plan sponsor, you can control how that plan is set up. You can make it include after-tax plan contributions and in-plan Roth rollover features and so forth. And as the sole participant, you're not going to have to worry about the non-discrimination testing that you would see in the plan. So all of these options we talked about today, these 4 options are great options for conversion and being able to participate in the Roth. But it's partly our job as advisors to also make sure that we're on top of any changes in the law around these particular plans. So I pulled out a couple, 3 here. Looks like that are really important right now. Re-Characterization, Jeff mentioned earlier, when you decide to do a Roth conversion, you need to go ahead and follow through with it and not change your mind. You can't go backwards here anymore on the Re-Characterization. You used to be able to, but that changed in 2017. The Tax Cuts and Jobs Act changed that, took that away as an option. Used to be a penalty and so forth, but now you can't do it. Hardship distribution rules under the CARES Act of 2020. So this is one of our new acts that has recently come out. You can take out, just like in a traditional IRA, you can take out up to $100,000 from your Roth IRA prior to 59.5 without early withdrawal penalty if you can prove somehow you've been affected by the COVID-19 virus. And the one we see the most often is going to, and probably affect our clients the most, is going to be the 10-year distribution rule for non-spousal inherited Roth IRAs. So the Secure Act, also a new act that came out this year, it basically, or effectively, I wrote in here, effectively eliminates the stretch Roth IRA concept. So if you're familiar with the stretch concept, you understand that once someone inherits an IRA, they have the ability to stretch that IRA, the value of that account, out over their life expectancy and only take out minimum distributions on that life expectancy. I mentioned that calculation earlier that involves life expectancy and account value at the end of the year. Same thing happens with a Roth. You know, what a great way to be able to grow money tax-free is for an inheritance situation, pass it on to your heirs. They can hold it for a long time if they're younger and just benefit from that tax-free growth year over year and only have to take out a little bit each year to satisfy that distribution. Well, the Secure Act now changes this distribution to a 10-year distribution. So the account will have to be distributed over 10 years. It can be done at the very end of the 10 years. It can be done in the beginning, anywhere in between, but it has to be done within 10 years. And the reason I put effectively here is because there are some exceptions to the rule. And for most of our clients, inheriting an IRA or Roth IRA, you may fall within this exception to the rule. The people that are in there are surviving spouses. So that happens to be a primary beneficiary for almost all of these IRAs. Minor children, not so much, but yeah, if you're a minor child or have a minor child, you don't have to have the 10-year rule apply. If you're chronically ill, same thing. If you're no more than 10 years younger than the deceased account owner. For example, you've got a brother-sister situation where, the sister inherited something from the brother who passed away, and maybe they're 3 or 4 years apart. She will not have to abide by that 10-year distribution rule. So despite all of these changes, again, these are the ones that are important right now. I think these conversion options that we've laid out for you today are all great ways for obtaining tax diversification and participating in a Roth IRA strategy where you may otherwise have thought you couldn't do it. So Jeff, why don't you take a minute and let's go through some of the pros and cons again as we start to summarize the call today.
Sure. Thanks, Ed. So, we can't stress enough how important it is to consult your tax, professional, your financial advising professional, and properly plan out whichever strategy you're going to utilize. The idea is to maximize, the positive and minimize the negative. Anytime I do, a little construction project or whatever, what the saying is, measure twice, cut once. And I think that holds fast for this situation. So some pros, just to reiterate, you got tax-free growth going forward in a Roth IRA. You got tax-free distributions, no required minimum distribution, which is huge. You've got tax diversification, and you've got tax-efficient wealth transfer. And tax diversification, there's one really good example. Let's say you're in a tax bracket, you're married, filing jointly, you're in the 12% tax bracket that goes up to a little over 80,000. If your income is starting to get close to that number, you can utilize your Roth to keep you in the lower tax bracket before you jump up into the 22% tax bracket. And so, it's another way to save a little bit throughout retirement in taxes. Some cons. So it may move you into a higher tax bracket, which could increase, this is the movement of money from your traditional IRA, may potentially move you to a higher tax bracket, which could increase the costs with other retirement benefits, including Social Security and Medicare. There's tax penalties for accessing funds prior to 5 years. Remember, I discussed that earlier of if you think you might need it, there's a situation where you may need it, you may want to wait. There's no option to reverse the conversion. That's now gone. And the tax is due in the year of the conversion. So you have to make sure you have those assets.
Thanks, Jeff. And just to reiterate, we've talked a lot about cons today, but in our opinion, my opinion, the pros certainly can outweigh the cons in this situation. This is something that's available to almost everybody as far as this Roth tax-free growth, tax-free distribution idea it goes. And so these are just ways that you can participate even though you thought you might not be able to. And just kind of thinking back to some earlier slides, the basic conversions, the one we see the most, the one you're going to work with your advisor on if you have questions, if you are in a situation where you might have too much income in retirement, or you were doing some cash flow modeling for you, and in retirement it looks like you're going to have a lot more than you need, and you're going to be in a situation where the required minimum distribution is going to force you into a higher tax bracket, creating some issues for you. So if you retire at 62, 60, 65, these are great times to take a situation where you're in a lower income tax bracket because you're no longer receiving your salary. And let's consider or look at doing some Roth conversions of some of your IRA monies. we can help you with that calculation. We would work with your tax professional. We have the ability to handle a lot of the calculating ourselves. But another area, the unwanted RMD, again, that's something right now that's popular, that we have a window of time here to take care of this. August 31st is the last day that we can take RMDs that have been received back until since January of this year and convert them, put them back in the IRA or convert them to Roth IRA. So you've got a little window here. If you feel like you're in that situation, talk to your advisor. Let's go back and look at those that you've taken out. You might want to go back and put in. Chances are the taxes have already been withheld and paid, so why not take advantage of that? The Backdoor Roth IRA and Mega Roth IRA strategies, they're, again, this Jeff went over one, I went over the other. They're complicated, but again, it's worth it if you can get the tax benefits that are available to you. So, if you're bumping up against those income limits that I went over earlier, then let's talk about this strategy, the backdoor strategy, the Mega Roth strategy. If you're at an employer that has a 401k that doesn't have that strategy, talk to us. We do a lot of 401k business as well, and maybe we can bring some new ideas to the table with the human resources folks at your company and help you participate, or other employees at your company participate in these type of things. So again, I just want to thank you, Jeff. Appreciate it.
Hey, Ed.
It up now maybe for some questions, Q&A.
Yeah, we've got a few questions that came through. I'm going to go ahead and read the question, and then we can tackle each one of them. There's two right now. So this question is, I have limited earned income. Can you contribute unearned after-tax dollars to a Roth IRA? And then after that, would like to move money from traditional investment account to the Roth.
Okay, so let's start with the last part first. Unearned, so they have non-retirement money they want to contribute in an investment account to a Roth. Is that correct?
That's correct.
So you can do that, but you're going to be limited to, depending on your age, $6,000 or $7,000 of annual contribution, and you may be limited on the income limitation to contribute to a Roth IRA. You could, however, also do the backdoor strategy, depending on if you have other IRA accounts. You could contribute to a traditional IRA and then convert it if you're limited on the income limits. So there's a couple ways that you certainly could put some money on an after-tax basis in just an investment account, get a Roth IRA started for you. Also with those contributions, kind of ties into your first question. If you have limited earned income, you have to have earned, you can make a contribution to a traditional Roth, but you can only contribute amounts that match your earned income. For example, you make $3,000 a year, you can contribute up to $3,000 a year to your Roth IRA. And similar in the traditional IRA, you can go higher. But anyway, in the Roth IRA, with that limited unearned income, you can put, and I just give you an example. This is my son. My young son has a job, a summer job, and he made $3,000 at his summer job, and he wanted to start a Roth IRA. Well, we were able to take $3,000 and start a Roth IRA for him because that's what he made. So I don't know if hopefully that answers your question. If not, we can certainly take it to another level. If you reach out to your advisor or call us and just let us know, we could run some calculations to see what makes the most sense for you in particular.
So the next one is, the question is 10 years from what date on inherited IRA under a CARES Act, 10 years from January 1st, 2020, 10 years from effective date of CARES Act. It's actually 10 years from the date of death of the person that you're inheriting the account from. That's when it starts, and it's recent. It's in the CARES Act, so it started this year. But it's 10 years. So let's say in 4 years, somebody passes away, you inherit an IRA. It would be starting then. You would have the 10 years to take out that money under the new rules.
Unless you meet that exclusion, unless you're eligible,
Right.
you know, that's going to get a lot of, you know, younger folks that inherit from grandparents, or if there's a, you know, a parent leaving it to a child. But again, if it's a sibling or if it's a spouse, typically you may not run into that. But
Yeah. So so the next question is, if I'm a highly compensated, which is over $200,000 a year individual, and my 401k plan does not have provisions to support after-tax Roth conversions, and I have no IRAs, what are my options to reduce taxes?
Okay, so let's go through that again. So you've got,
So is it highly compensated,
Yep.
above 200,000? The
Yep.
401k plan that they have does not have provisions to support after-tax Roth conversions.
okay.
And they have no IRAs. So how can they reduce taxes?
So you can do several things potentially. One, the easy one would be to consider the backdoor Roth IRA strategy. With no other IRAs, you don't have to worry about the pro-rata calculation. You will be limited on your contribution amount to these $6,000 or $7,000 based on your age. But then we could turn around, do a conversion to Roth, and avoid the income limit on that conversion. So that's one way to, you know, you're not going to get a tax benefit on the front end there, but you'll get tax benefits along the way and on the back end. The other thing I would say, again, I don't know where you work, but if you are an employee, non-owner employee, one thing that could be available to you, or maybe should be, again, we could talk to your 401k provider or your administrator, your CFO, you know, a deferred compensation arrangement. A lot of times for highly compensated non-owners is a great way. It's just, if you think of it as a 401k mirror, sometimes they call it, you can set up a plan so you can put more pre-tax dollars in over and above what you're putting into your retirement plan, assuming you're participating in the retirement plan. And again, even on a smaller level, if there's a safe harbor in that 401k plan, you can max that out for yourself, as opposed to getting money back at the end of the year. So I would say backdoor Roth IRA is one way to do it. And then consider talking to someone at your employer. Again, we'd love an opportunity, if it's available to us, to look at some non-qualified executive benefit planning ideas, such as deferred compensation, where you can actually reward key employees. Sounds like you're a key employee at the firm or the company there. But that's something we do, usually layers right on top of the 401k, and can give you some really nice tax benefits as the employee.
And Ed, what would stop the person from moving some money from the 401k to a traditional IRA and then rolling it into the Roth, and then moving it into the Roth, doing a conversion?
So depending on the age of the person, that's certainly an option. But if the 401k has to have an in-service distribution, or they have to be 59 and a half, typically, to roll money out of the 401k into a rollover IRA, and then they could do the basic rollover, as we talked about there,
Right.
in the conversion. I mean, so that maybe is a third option there for them.
Sure. So, and the final question we have is, please review the max limit of contribution limit for Roth conversion in 2020. Is it 5,500 or 6,000?
So say that again.
So the question is, please review the maximum limit of contribution limit for Roth conversion for 2020. Is it
Okay,
50,000
so
or 6,000? I think there's two questions there.
Yeah, there is no limit on conversion when you try to convert it to a Roth IRA. The main thing you have to worry about is the taxes that are due. So you have to
Right.
make sure you can pay the tax. If you have $100,000, you can convert $100,000 to a Roth IRA. The income limit comes into play when we're talking about new contributions, new Roth IRA contributions. The contribution limit is $6,000 if you're under age 50 or $7,000 if you're 50 or older. And it begins to phase out as your income goes up. So if you're making less than $196,000, then you can fully fund, and you're married, filing jointly, you can fully fund the Roth IRA. Now, again, it gets a little complicated, but if we go back to the traditional IRA, that's the deduction limit. But the traditional IRA, you can contribute to. There's no income limit, so you can contribute to it,
Right.
but still you're $6,000 or $7,000, and then you can convert it. So if you're bumping up against the income limits to contribute to a brand new Roth IRA, you can use the backdoor strategy through the traditional IRA, no income limits. If you're talking about conversions of existing IRAs, then there is no income limit and there's no limit to the amount you can convert. It's just the taxes that are due on that amount.
So I hope we've answered your questions. And if you have more, please, let us know down the road. We're happy to sit down and talk to you about participating in this and providing you guidance in the future.
Yeah, and thank you again. And just be sure to join us tomorrow if you can. Cliff Hodge, our Chief Investment Officer, is going to be doing the monthly market update. And those have been great, very, very timely, and he puts a lot of time and effort into those. So join us if you can. Check us out on our website, cwgadvisors.com. There will be some follow-up material from this call on there, so check that out. And we look forward to talking to you again soon. Thank you.